Good morning. Good morning. Good morning. It is a good morning. So happy Monday to y'all. So, as you can tell, I've got a little bit of an itch. I got to take care of some desire to the jawbone a little bit. So I figured I'd lend my time since it was made available for the next couple days. Today, tomorrow, and Wednesday, we will be live streaming for 4 hours. So 8 a.m. to noon. Today will be the introduction, kind of like a relaxed discussion over tape reading. I'm going to talk about certain points that are going to be salient tomorrow and Wednesday. Um, my goal is to kind of like present a nuts to bolts approach to bias and the lack thereof, because that is the number one question I get predominantly in either emails, messages through TradingView, or on comments on Twitter, comments on my videos. Michael, could you just please teach me how to determine the bias? Okay, and we're going to talk about several forms of bias, when to look at one and when not to consider it so much. So it's kind of like the audio book version of the chapter that will be in my book. And yes, they're on their way. Okay, I'm not in control of when they get disseminated, but they're on their way. But this is going to like be 3 days worth or 12 hours worth of audio commentary directly from me. And it'll be used over the scope of real live price action, which is not something that is communicated effectively, in my opinion, when you're doing it with a book. Okay, because invariably, if you buy a book and you look at it, whether it be my books or anyone else's books, and I can testify that this is true for me as well. When you look at a static image or static images, and a concept is being promoted or suggested as being viable, it's hard to garner the the confidence in it when you're just looking at something that's already happened. Okay, so that's the reason why I like to go over live price action with the smallest of time frames, because it proves, number one, efficiency. It proves the understanding that the logic is really there. It's not contrived. It's not a conjecture. It's something that really is there. It can be measured in terms of a daily experience that what you see me do today, tomorrow, and on Wednesday. This is what you should be doing regardless of where you are in your prowess, skill set, experience, whatever. Before I start, okay, because I kind of want to go right into some of the things, but I have to have a little bit of a preamble here. It's important to know, if you cannot grasp from your analysis, and I'm going to show you what I do every single day. Okay, I'm going to talk about what I do on the weekends, but then I'm going to show you what it is I'm looking at before 8:30, and then what I'm looking for, what I'm anticipating between 8:30 and 9:30 when the equities market opens up, what things I'm considering, how much weight or emphasis do I place on one thing or a few things and not so much on others. Okay, so it kind of like gives you the practical, this is what I do, this is how I determine what it is I'm expecting in terms of price action, whether there's a bias that should be considered for that trading day or that session or that week, or should I trade without a bias? So I'm going to teach you how to do both of those this week. Okay, I can't promise that I'm going to cover everything that's going to scratch every itch that you have about it, but that's okay, because I will leave a post Wednesday evening on my community tab on my YouTube channel saying, if you have something that it didn't address or answer, I guess, sufficiently enough for you, it's kind of like a suggestion box for you to leave a comment. Now, I see every comment. You see your own comment, but I see every comment that comes. So if it's something that you want me to touch on as a later discussion or whatever, if we do a live tape reading session again beyond this week, which I'm certain we will, I'll kind of like bring that into the conversation and kind of address it. Okay, that's usually how I do things. But the impatient folks, they want everything right now because they have a TikTok mentality. Give it to me in 30 seconds or it ain't worth listening to. And if that's what your mindset is, it's probably not going to be good for you. So this is for people that really want to learn how to do this independently, not have to watch other YouTubers, me included, not to buy courses, not to buy books, not to buy any of those things. So I want you to know, while my books are coming, you don't need to buy them. Okay. In fact, you probably shouldn't buy them, but it's for people to know that all these concepts were authored by me. And that's the only reason why I'm doing it. These 3 days are going to be the better version of what I'm going to say in the chapter about bias, because you're going to see it. You're going to see it explained. You're going to see me outline what it is that's important, and then how you can begin the study of learning how to do it on your own. But also, I'm going to untether the necessity for you to have a bias. Okay. In the beginning, I think it's important for a trader that has next to no experience, or if you're someone that has been hit and miss with your results. Sometimes you can get lucky and get a profitable week or a profitable month. It may be a short span of time that you are able to trade correctly and therefore see profits increase in your equity. But then something happens and you unravel and you lose, and it goes into a tailspin and you lose all your progress. I'll address a lot of that on Wednesday, and I'll also cover on Wednesday how to hold on to trades and trust what it is I've taught today and on Tuesday, and what I will close with on Wednesday. So it'll help you understand why you shouldn't be afraid, okay, and how to overcome that, and how to manage all those things using price action and not having a whole lot of necessity on, I have to know what the high of the day is. I have to know what the low of the day is. You don't need to know that. Okay. So first and foremost, let's get into it. Let me just post one more time. I want you to see the risk disclaimer, because some of you just showed up here a little bit late. All right, so I had to toss that in there once more. Because I know some of y'all like, okay, I'm going to get in here and trade on everything he says today. So when we're determining, or when I'm specifically working on a bias, I like to build that idea ahead of the Sunday opening. Okay, so whether it be Friday evening, or whether it be Saturday during the day, or early Sunday morning, whenever my free time is available, because my wife and family kind of like dictate everything now. So I have to find time for this stuff on the weekend. But whatever time it is, it's usually about 30 minutes. It takes me about 30 minutes to go through all the major markets. And the first and foremost thing I'd like to look at is where we are in terms of seasonal tendencies. Okay. So in my opinion, seasonal tendencies are best determined by Steve Moore. Okay. Steve, this is not a paid advertisement. I've said this in my mentorship videos as well. Steve Moore probably heard about me because I've been repping his stuff since 1995, and I have a little bit larger audience now. So when I say this is a resource I believe in, this is a resource that I use, he does not give me anything. I don't get a kickback. I didn't ask for a kickback. I have no affiliation with any company. I don't have any kind of affiliate links. I don't do any of that stuff. So when I share my opinion, it's raw, it's real, and I don't care if the people like or don't like it. It's something that either I use or I don't have a use for it. Okay. But one of the best tools that has served me well in my analysis for over 32 years coming November, this tool, this resource of understanding the roadmap of what usually, not always, but usually happens in the marketplace, is a seasonal tendency. Now, Larry Williams was the first one that ever wrote a book about it and put it in publication. And I think, if I'm correct in my title, no, not my title, Sure Thing Commodity Trading Seasonal Tendency, something to that effect. It's a little misleading, I think, in terms of a title, but everybody does clickbait titles on their videos now, so he was like using clickbait back then. But some of those seasonal tendencies were like bangers, like real easy, real simple stuff. But some of those markets don't even trade anymore. For instance, like pork bellies and egg futures. Okay, but eventually, over time, there was individuals like Jake Bernstein. He had a big run with seasonal tendencies, and I've never subscribed to his stuff, not to be disrespectful to him, but Larry had a lot of affinity for him, and it may be just a partnership that they had at that time, or maybe it was a real good friendship, maybe it still is, I don't know. But I didn't have any, confidence in his work with seasonal tendencies. And that might be met with opposition from people that, like me, as a dinosaur, have been here for a long time dealing with these markets. Maybe you had success with it. Maybe you learned something from it. And that's fine. I'm not trying to disparage anyone to not look at his stuff, but you're watching my video and you're watching my live stream. So you're kind of like here to get my opinion or what my take is on something. My opinion, the pentacle of the seasonal tendency market, the person that has the best product is Steve Moore. And you can do a search on his website, and he doesn't ask a whole lot in terms of what it costs to get the information. But these things, these graphs, he'll show multi-year seasonal tendencies. And I used one of them the 8th of this month when we did our live stream. I explained to you, and I'll kind of like go back over what it was I was referring to. But you can go back and look at the April 8th live stream where I explained how we're going to be seeing several hundred handles lower in the stock indices. And you see it in your chart. Or if you haven't noticed it, you might want to look at it. But seasonal tendencies are the first thing that I consider. And I usually refer to them on a weekly basis. I want to see where we're at. And what I'm looking for, and you're probably like asking, why don't I show a seasonal tendency chart? Because I want you to go look at his free samples. Okay, look at a free sample, and that's what he offers. And there's a lot more that he offers, but I don't use that. I just look at his seasonal tendency over the view of the multi-year overlay. So what he'll do is he'll compare, say, 15 years of what price has done for any given market, and then he'll compare it with a longer sample set. So what I like to look for is where there are two sample sets of time where he's measured the fluctuation of price. And if there's a period throughout the calendar year where both of those measurements, and it kind of looks like two moving averages that are like moving along on this graph. And I know some of you are mad right now, like, well, I wish you would just show a chart. I don't want to do that. I want you to investigate it yourself. And it's free to go look at his samples. But I show you a lot of those in the mentorship videos. And I'm repping him then. I'm telling you, go use his resources. And because I don't get paid for it, and because I actually use it, I've actually made real money with it, lots of real money. It's not something that is a conjecture. Like I said, it's not something that is opinion. If you know that where you live and the weather patterns suggest that something may or may not happen during the weather cycle, like for instance, we're in May in this week. Coming this week, we'll be entering the month of May. When we get into the month of July, where I live in Maryland, the east coast of the U.S., it's highly unlikely that we're going to see snow or a blizzard in July. So that's a seasonal tendency. That's a pretty strong seasonal tendency. Now, how about right now? Could it snow technically in April? It could, and it has. We've had blizzards in April in Maryland. So that would be an example of a seasonal tendency where maybe one period of time where he's measured the seasonal tendencies, it may have gone up for a few weeks. And in a longer term view of what a market has done seasonally, it may have done the opposite. I don't like to trade those. I like to find, and it's not a lot of them that occurs. So there's like this little sweet spot in the year. I look for the best period of time in the spring, and I look for the best period of time in the fall. Because what I've done is I've cherry picked the very best of the best times to trade. Because the spring season and the fall season, that's your turning points on the higher time frame, monthly and weekly and daily charts. Don't take my word for that. And it probably went right over your head, but that's the part where you're supposed to be writing down your notes. Okay? Because if you're going to be a long-term position trader or you want to have a long-term bias, those turning points, they're like the bookends. Okay? They're the parameters for the big, huge runs every single calendar year are usually boxed in by the extreme high or low of those two time periods. Okay, so my emphasis is focusing on markets that I typically trade, which is index futures, bond futures, and I moved away from Forex, but you can trade currency futures. Like if you don't want to be in Forex anymore, you can trade currency futures. And it's it's the same thing, but there's a slight little advantage to trading index futures because they're a little bit more liquid and they have a whole lot more smaller intraday setups. And we'll talk about that real time today, where I'll touch on not having to have a bias and how can you grind out an income, okay, without a bias. Because if I had to be asked what my opinion was of the audience listening today, or that audience that will watch this video or the series of videos that we're doing, the the common denominator would be is you're not either confident in knowing what the bias is. And what is bias? It's where you think the largest probability of movement is going to be. You're not trying to predict the closing price. You're not trying to predict the high or low of the day. It's distinct from what we're talking about today. You don't need to know those things. There's things to determine that, and I taught that in mentorship videos on this YouTube channel for free. You don't have to pay for it. You don't have to go to other YouTube channels that are trying to hawk my stuff and sell it. You're a fool if you buy that, okay, because it's here for free. If you can focus on the spring and fall session and anticipate directional runs that last for weeks to months, it's not always a straight shot from a spring high to a fall low, but predominantly it is. And again, that's the part where you're supposed to write that down. So what happens if you are in a market environment that's bearish? Wow, you really have a loaded deal, because in spring, what is spring? April, May, okay, April and May, there's this transition that'll send the markets lower and going down into the late summer weeks or months into September or October, and as late as the first week of November. But very rarely does it do its turning point in November. Usually you'll see the turn between the last week of August and the second week of October, and that's usually the low of the year. That's not 100% always happening, but that is how I look at the market. Every single year I go in with expecting that to unfold. And then what I do is I look at the details that the market's actually showing me day by day, intraday, week by week. How are we behaving? How are we anticipating these targets? Are they still probable? Are we still likely to trade lower with that mindset? Now, what happens when you're in a very strong bull market condition, like we've been for several years now? That means that the spring highs can tend to be quick and sudden initially, and then it can go consolidated a little bit and then slowly drift down. Or because now it's a presidential election year in the US, those spring highs down the fall lows don't tend to be as crisp or pristine in price. It's a little bit muddied, and sometimes it can be altogether rejected, and there's just a short-term drop in the spring months. And then when we get to mid-May or first week of June, we take off and we start going higher. And we don't even try to do anything going into the lower extremes for the summer months and or making a low in the fall. There will be likely a low that forms in the fall. Any environment, whether it be a bearish market or a bullish market, it's just a very strong tendency for the market to create very easy long positions, opportunities to see the market rally. And maybe short-lived, but trading in September, October, and the first 2 weeks of November, being a long holder, looking for longs, that is like some of the easiest stuff you'll ever do as a trader. Like, it's like easy money, it's easy opportunity, it's easy. Everybody's stuff, if they've just filtered out how to be a buyer only during that period, chances are your probabilities will now shift in your favor if you hadn't been doing it. But the problem is everybody looks at the chart and they think trend is friend, but it's not in the end. So I like to look at those two extremes of the year. So that way we know now the highest form of determining bias, I gave it to you for the full year. How do we anticipate power 3, which is the accumulation, manipulation, distribution of price action on any given time frame? It's on every time frame. It's on second charts, 1-minute charts, 15-minute charts, all the way up to whatever time frame you want to create in TradingView. You can create your own unique, customized time frame, and that's one of the benefits of having a platform that's not one trick pony only. You can create your own time frames. If you want to look at an 18-minute chart, You can create that. It's a custom time frame that you can create. So, and we'll talk a little bit about that on Wednesday, how to go through and look inside price without the typical perspective that's usually seen. And even in my like the early lessons and the elementary lessons that I have on my YouTube channel or have done in the past, where I look at specific canned or pre-selected time frames. I only did that because it's easy to teach a large group of people if we all start with the same baseline, and then we can obviously build upon that. But after looking at seasonal tendencies and looking for times when a market that I'm interested in trading has both the longer term and the intermediate term seasonal tendencies agreeing. And what does that mean? Steve Moore has the graphs that show over a calendar year the movement generalized of what the market will likely do any given time over that calendar year. I want both the long term and the intermediate term seasonal tendency to be moving in the same direction between one time of the year. It may begin at a specific month. It may begin halfway between the beginning and the end of a particular month. And I mentioned on April 8th in our live stream, I said, I'm anticipating the market to move lower. Several hundred handles, not 10 handles, not 25 handles, not 30 handles, not 50. I want to see hundreds of handles. Okay. And now, just because we have a seasonal tendency there, that doesn't mean it's a green light go. Okay, it's Monday now. I've been waiting all weekend to trade. It doesn't mean to go out there and start doing something right away. You have to go in and anticipate price presenting these opportunities, and other things have to compound as a confirmation. What it is you're looking for is really there, and you're not just trying to force your will on it, because you can still fall victim to your own will if you force it, because the market doesn't really care too much about what you think or what I think. It's going to do what it's going to do, and it's our job as an analyst to get in sync with what it's likely to do. And that analyst aspect is not trading yet. Okay, you have to be able to see things for what it is, what it's likely to pan out, and then over a period of time doing it, months, if not at least a year. That's why I teach everybody that's learning from me should expect to invest a full year minimum, because you're not going to get the full picture. You won't even appreciate what I've already said right now, and you'll turn off the stream or you'll go do something else, and you'll fail because you haven't considered the very few things I've already covered here that are paramount. That's how I feel confident when I was going on Twitter and telling you minute by minute where the next candle was going to go and follow this and follow that, because it's based on those time periods where the seasonal tendency was in agreement, the market structure was in agreement. I understood the probable narrative, and we're going to talk a little bit about narrative tomorrow. The idea of how all this stuff blends together. It's real hard to be anxious when you have a firm grasp on all these components. It doesn't mean that you're going to be 100% accurate. It doesn't mean you're going to be without a losing trade. It doesn't mean that you won't have drawdown in your trade. It just means that you won't be shaken out of your trade. And if you do get stopped out, it won't change your approach to using this information. That's maturity. And it's hard to be mature in the beginning when you don't have any idea what it is you're supposed to be doing. You're jumping from one method to the next, one guru to the next, one video of mine or one video series, thinking one's going to be better than the other. There isn't any one better video. There isn't any one better series. It's a starting point, and then go through the content, because I always pull in all this stuff. Eventually, given enough time, you'll hear me talk about things I've talked about very infrequently, but still they're essential. But my assumptions is you've taken notes and you understand that component. So with seasonal tendencies aside, the next thing I look at is the economic calendar. So this is an example of it here. This is the Forex Factory calendar. And if you're a Forex trader, you would obviously have things toggled for those currencies. Right now, I only have it set up for US, and these are the settings here. I don't usually look at the yellow, which is a low impact news driver. I don't care too much about that. I want the orange, which is medium impact, and then the high impact. If you're a trader for Forex, you would toggle the pairs that you're interested in trading. You don't need to toggle all of them. Okay. You don't want to dilute your attention. You want to keep everything focused. And once you have that, then you can look at your full week here. So you can see on Monday today, we have nothing really in terms of Forex Factory. There are some events that you can see on Econo Day. Okay, Econo Day is another calendar that is more equities specific, and it's, to me, if you really want to be a perfectionist, that's the calendar you want to look at. But in terms of teaching individuals that have a very low experience, or just coming into understanding the markets or being interested in them, this is a calendar that's very easy on the eye. It's easy to manage. It's easy to see, the big triggers for when the markets will likely see some kind of excitement. Okay, and that excitement is what we call manipulation. Many times during the times of these reports, like tomorrow we have 8:30 a.m. the employment cost index. I don't ever consider the data. I could care less about these data points, because these are just excuses for them to, and when I say them, it's those individuals that are in control of the marketplace. Just like out in Las Vegas, when you go to those casinos and they give you the free room, they comp you, free dinner, free events, magic show, comedian show. They'll give you all that stuff because they know if they can get you into the casino, given enough time, you're going to pay them. You're going to lose your money. So these are like scheduled events where you're going to have the opportunity to lay your money down and leave it there and go home without it. We call that a loss. Okay. But a newbie or a inexperienced trader, they see it as they got me, or that guru taught me something that doesn't work. When really what they're doing is, and you know this as truth, you see these big events, you hear other people talk about how there's going to be a lot of movement, and you think, I could make a lot of money. Yeah, you could. You could also blow your account on that one trade. Don't believe me? Try to trade CPI or PPI. It's gone. So when we're looking at this timing aspect, I'm anticipating some measure of manipulation. Okay, so what I like to do, and this helps build, not kind of like introduce the idea of narrative building here. I like to look at what price has done right before these scheduled time events where the economic calendar will produce the data and present it to the public. Okay, individuals that are in better positions for information's sake, they have the ability, much like politicians today. Nobody wants to be a politician to turn things around, but they want to be a politician because they have advantage. They have information before the public gets it, and they can go and they can buy their stock options. And people that make $200,000 as senators, all of a sudden they're multimillionaires in a year or two, and there you go. So there's smart money that has the advantage of knowing what these drivers are going to be like real time. And it's not to say that these events and the data that is released at the time, and or the initial move that occurs at the time that the report comes out, it doesn't mean that that's the right move. It doesn't mean that that's the move that's going to be sustained and it's going to keep moving that direction. Many times, and this is really what I'm looking for, I'm looking for these opportunities where I have a seasonal tendency in mind, that I have a long-term macro directional bias. Because if you can trade in that right there will filter a lot of your losing setups out of your results, which is something that you should do a lot of work to try to do, versus I'm going to open up a chart on a 1 minute chart, because ICT students, we all trade 1 minute or less. And that's where smart money trades. Smart money does not trade on 1 minute charts. Okay. They don't do that. Smart money trades on monthly, weekly, and daily charts, because they can't move billions of dollars on a fluctuation on a 1 minute chart or a 15-second chart or a 30-second chart. But you're not trading the volume that they're trying to push into the marketplace. So you have the advantage, being a small fish in this big ocean, where you can go in and place a trade in very small, ultra short-term time frames and capitalize on that and make 10, 15% in a day. And over time, that compounds. And then eventually you get to a trader size where you're doing reportable trades, where every commodity or every market has a reportable threshold. When you start trading a certain number of contracts, they have to be reported. You're counted in the COT then, the Commitment Traders Report. Your trades would eventually be a part of those numbers. But when you're not, you're still considered a small fry. Okay, and you can be trading lots and lots of contracts, but still be considered by definition in terms of commitment traders, still be a small trader, a small speculator. So I like to look for those periods right before the time of the economic report coming out, that I anticipate that economic report being a Judas swing. A Judas swing is a fake run. It's a price run that's quick, it's sudden, it's explosive. It runs directly into a pool of liquidity. That means above a high or relatively equal highs for buy side, or it reaches up into a fair value gap, which would be in many instances a SIBI, a sell side imbalance, buy side inefficiency. So a down close inefficiency. Those are the two things I'm looking for if I'm bearish. Now, how do I know which one's going to happen? How do you know, ICT, which one it's going to do? Well, if there's no inefficiency, what's it going to do? It's going to run for the high or a group of highs. It could be 3 clustered highs in relative same price area. I'm going to pick the highest one. And I'm going to see, does it want to reach there? If it reaches towards it but falls short of the highest one of the relative equal, or if there's like 3 of them there, if it doesn't run the highest one and it starts to drop, I don't trust that drop. That's usually many times a trap where they'll then pump it one more time, run that one, take the higher high out. Then the break in structure after that, when it moves lower, then I'll be all over that like white on rice, selling short. But that's given I'm in a seasonal tendency that's bearish. I have a weekly range that's likely to reach for something, and I'm going to cover that part today. But I want to give you these are the points that, imagine me trying to describe this in just text form in a book. It doesn't hit the same. And you won't even read that chapter. It'll just be like, well, I'm going to go to where the pictures are. And this is the stuff that filters out all of the majority of why losing traders lose so much, because they don't factor these types of things in. So what I'm saying is if I have a seasonal tendency that I'm bearish, then I have a expectation that the market's going to introduce volatility. And that's what this calendar does. It tells me, like a TV guide, when do the games come on? If you're a sports fan, I'm not. If you're a sports fan, how can you know when the next football game or the next basketball game or the next rugby team is going to play your this, that, and other thing? You go to your TV guide. Every platform that has programming, TV programming, will tell you what time, what channel, and what's happening then. That's what this does. It tells us when we can sit back and relax. Now, as a new trader, when you first started trading, you never even looked at this stuff. You're looking for patterns. You want to see a head and shoulders. You want to see a harmonic pattern. You want to see moving average crossovers. You want to see order blocks. And you want to see, fair value gaps and breakers. And you want to see all these other things out there. When they may exist in price, but because they exist in price alone without any context, that's why they will fail. But you'll walk away with an infancy in terms of experience, thinking that therefore you've proven that this stuff doesn't work, so therefore let me go find an indicator that's going to tell me how to do something. And then you'll discover that the indicator isn't telling you anything except for to trade at the wrong time, buying when you think it's oversold, but it's in a bear market, so it's going to stay oversold. So that's why I opened up this lecture series with this, because this is the stuff that matters. This is the stuff that I had to learn by blowing lots of accounts as a 20-year-old. I didn't learn this lesson from books. I had to learn it from losing real money and going back and saying, okay, why did my trade lose in stunning fashion? I was long because in the beginning, that's all I ever wanted to do. I didn't trust being short. And I would get these big, huge drops against me, bang. And because I was trying to trade without a stop loss, it took all, if not majority of the trading account away from me. And it's demoralizing. It sucks and it's avoidable. All of that is absolutely avoidable. It doesn't feel like it, especially if it just happens to you, but it is avoidable. And you have to, number one, build in the permission for you as the speculator, the trader. Right now, if you consider yourself the student, you have to give yourself permission to be wrong. Because if you equate everything to right or wrong, you are going to struggle in this industry. You are going to struggle. You're going to be angry all the time. You're going to be scared. You're not going to trust your decisions. You're going to let everyone else around you influence you. And it's never going to be the good influence that's going to affect you. It's going to be the bad. And it seems plausible to you when you're in that state of mind. let's look at ICT's videos. Let's go look at somebody on social media. Look at so and so, he's selling a course. Look at so and so, he does live streams. Look at so and so. And what you're doing is you're trying to replace that uncomfortable state of mind and uncertainty and a lack of a plan or understanding of what it is that you're trying to do that should repeat more times than not. You're trying to replace that discomfort with distracting your attention with someone else doing something. Because in your mind, if they do it wrong and you follow them, you taking that loss, well, you've built in, well, it's their fault. They did it to me. And your subconscious retains that as you didn't do anything wrong. And that's a problem on all fronts. You shouldn't be asking anybody else what they think about the marketplace unless you're looking to fade them. And that's what I do. I look for the public in their live streams, in their chats. When I have a setup that is, I'm bearish, I'm in a seasonal tendency that's bearish, I have a market structure that's bearish, I have a market that is rallied up into a short-term premium, and I have a day when there's going to be a news driver that's going to be releasing with a high impact, which is always a red folder, or a medium impact, which is an orange folder. My focus is limited to that. So I'm picking. Think about it. You ever wonder why I was only going out there certain days on Twitter and say, this is the candle I'm watching on this 1 minute candle. I'm watching this. Go back and look at the calendar on those days. Look at the time. It's the same thing all the time. It's just like everybody else that wants to be a couch potato and they know what their favorite time and channel events are going to be. I know what I'm looking for that given week. So I want to see a manipulative price run, which is a Judas swing, something against what I expect to occur. An example would be if I'm bearish, seasonal tendencies bearish, the longer intermediate term are agreeing in terms of Steve Moore's graphs, and that seasonal tendency is implying that we're likely to go lower. I want to see a news impact driver on a calendar like this that has a red or orange folder at that given time. Now, ideally, what I want to see is this. I want to see right before 8:30, if I'm bearish, and I'm not saying that this is the case, I'm just giving you the nuts and bolts. If I'm bearish, I want to see right before 8:30, I want to see it drop down below a short-term low first. Why? Because that triggers individuals on a breakout short or knocks out the long holders that have have a sell stop right below a recent low. I want to see that happen before the news driver hits. Then I want to see at 8:30, I want to see it rally up. Now, again, someone's going to take this soundbite and place it on, say, he said this is tomorrow. I'm not calling tomorrow's price action. I'm giving you the procedure of how I go in and I look for very specific days, weeks, months to trade, because I'm not trading every day. Just because I can day trade doesn't mean I'm an everyday trader. And you shouldn't be either. And that flies in the face of everybody that sells courses right now, because they want to tell you it's an everyday occurrence. Not if you don't know what you're doing. That's a recipe for disaster. And it's a recipe to cultivate poor habits, bad habits. Okay, you don't want that. So the way I teach is I want to give you the best of the best, so that way it filters out all the opportunity, if not all, at least the majority, because you really never can. I can't reduce it to 100% unlikely that you're going to have a losing day. You're going to have a losing day. You're going to have a losing trade. It's going to happen. But you're going to see, if you apply this process, it filters out. And that's what you really want. But you don't understand that yet because you're brand new, or if you've never had any success in this. You already have a predisposition to, you're looking for any excuse to justify everybody is a fraud, everybody's a scammer, nobody makes money, and you just want to have the permission to say, I don't want to do this anymore, because you can't hack it. And there's nothing wrong with that. If that's how you feel, don't fight it. Just leave. Don't trade. You'll probably be better off not trading. But for the individuals that are just simply not going to take no for an answer, and you know that given enough time and effort and doing things correctly, you can be profitable at this. These lectures are for you. But if you have that first initial drop against the Judas swing that you anticipate, so in plain terms, you're bearish. You want to see it drop right before the high impact or news event that's medium or high impact. You want to see it drop to take the stops that you think is going in the right direction, but you're not taking that trade. Now, all of a sudden, light bulbs are popping off. Why doesn't ICT trade this here as a break in market structure? Why didn't he trade that? Why did he wait for? I'm telling you right now. I'm telling you. Are you taking notes? Probably not. You're waiting for the charts to get on the screen. But this is the stuff that matters more, because the price action, that's the last thing that's important. All of this is the most important thing. I could write a book or series of books just on this topic, and you won't read them, you won't like them, you'll leave bad reviews, but this is the heartbeat of why successful trades happen. No matter what you trade with, this is why your trades made money. That's this series. That's this whole live stream lecture today, tomorrow, and Wednesday. How to know why your trades work, because I'm going to tell you right now, it isn't working because of your indicators. It's not because of some kind of harmonic pattern. It's not because it's a down close candle right before the up move and it came right back down to it. That's not it. That's not it. There's many times where the market makes a run and drops down to a down close candle, and that ain't an order block. What makes it an order block is these factors have to be there. You see how fast all of these other guys out there that are trying to tell you what an order block is, it fades away real quick. It fades away because they don't have this. And I'm giving it to you all publicly, so you all have it at the same time. You want to see the smallest little degree of movement dropping down to take out a short-term low. What that does, it trips traders short on a breakout because they think that news driver is going to make a big move and they want to get in. They're gambling. They place a sell stop to get short when it breaks out to the downside. You are waiting because you know that that's likely to happen. And when this does happen, and then you anticipate at 8:30 and minutes after that, it should be running north. It should be explosively running higher. That rips the face off of anyone that went short, generally John Q. Public. Now what happens is traders are trapped going long because they're trying to buy the breakout above a recent high. They're trapped net long, and smart money goes in at that moment and sells into that rally because that's exactly what they're waiting for. That's exactly what I'm waiting for. Now, you, as a inexperienced student, may listen to that and think, man, I don't think I can do that. You probably won't be able to for a while. But that's not a problem because you can go into model 2022. Okay, wait for a market structure shift again below the low that was right before the news event. When that low gets taken out, then you have a market structure shift. Oh, how do you know what low to pick that causes a market structure shift? All these things have to be there because think about what the market's doing to what classification of trader. If you're anticipating lower prices and you're expecting some kind of manipulation to the upside initially, creating the high of the session or the high of the day, everything prior to that has to be used in concert with what you're anticipating. And when you know these things going into that event, and then you see them panning out, you can see, okay, well, I can see John Q. Public, he's sold short. Or the people that went long initially, they get stopped out with that drop down below a short-term low right before the news impact driver at 8:30 or whatever the time frame is. And then that rally up, after they get stopped out, if they're long, they're going to do what? They're going to chase it or do nothing. Most of the time, they're going to be nothing. They're just like a deer in headlights thing. I got stopped out. Now look, it ran without me. If they're smart, they won't buy it and chase it. But most of them won't do that. They'll be like, oh, I got to get my funded account passed. And they're going to chase it. And it's already ripped. But you are waiting for that run higher because that's exactly what you want, because it's done harm to two sides of the marketplace. It's trapped traders short right before the run at the news impact driver, then rips their face off and stops out anyone that's already short by running the higher high. You're not worrying about any of those things. These are all things that you anticipate seeing in price. Now, two things are happening right now. In the audience that's listening to this, Number one, there's a large degree of you that are thinking, show me what that looks like on a chart. I will. But conceptually, in your mind, these are the things that I do, why I pick certain days. This is what I'm going to call the market. This is what I'm going to call the market. This is what I'm anticipating. Everything's there. Why would I want to go out there and say, okay, I'm going to try to figure it out as I go today? That doesn't communicate probabilities. It doesn't communicate authorship. It doesn't communicate anything except for, well, I'm just going to see what happens. And that's usually what happens with majority of traders. They try things before they understand how to do it. And if they do succeed, they contribute that to skill. Or I was born to do this. I'm a goat. There is a such thing as beginner's luck. I had that. But then I discovered I didn't have it. And I had to learn how to trade. And it took years to do it. Many of you wouldn't like to be told on the first day of you trying to learn this, it's going to take you years to learn how to do this consistently. And some of you would hear that and say, well, I ain't got time for that. Let me go to TikTok and see who's telling me how to do something right now. And that right now thing is just a reason for you to go out there and lose money. So these are the nuts and bolts on how I start the framework for a bias. If those things all agree and we're on like a Monday or Tuesday or Wednesday of the week, oh man, you can't understand how comfortable it is to trade in those environments, because I have so many things in my favor that even if I'm trading the largest degree of leverage that I would have on my trades, which is usually about 4.5%, that's not to say that you should risk 4.5%. But my large scale size, when I feel confident in these environments that I'm describing here, I will trade as much as 4.5% per trade, per position. If I take a loss, in these instances, I will not reduce my risk and cut it in half, because everything still stays the same and I'm willing to take that. Well, what you're saying is you're willing to lose 9%. Yes. Because that 9% isn't going to cause me to go into a tailspin and then go, well, I'm willing to lose 18% now. I'm willing to lose 30% of my account today. That's not what I'm inviting. I'm saying that I have the parameters still there that, yeah, I may have had my stop loss in a position that was too thin for the given market volatility, or I was too overzealous about limiting the risk because I wanted to get to that 4.5% risk. If I get stopped out, I teach you, because you don't have the experience, you don't know what you're really looking for yet, and you don't have the continuity of relying on this information to see that it pans out more times than it fails. You don't have that. That has to be collected over time. And all of you are going to require a different measure of time. But I have the probabilities that can shift me right back above that 4.5% drawdown. And then, because I'm holding for trades that are 50, 75, 100 handles or more, even though I've taught individuals to start with like 10 handles or 5 handles for S&P, just to give yourself something to work with and build a baseline on. That's not to be saying that should be your career, that's your model in its entirety. No. Is it a breadwinner? Absolutely. Can you buy groceries every month with that? Yeah, absolutely. Can you pay your mortgage with it? Absolutely. But on the same side of that coin, if you turn it over, I have plenty of reasons how I can blow my account, because there's a lot of 5-minute or 5-handle fluctuations intraday. And if you don't know what you're doing and you're just in there trying to throw darts because you want something to fall in your lap and give you an attaboy or attagirl pat on the shoulder, you got to be very careful not to take this as skill versus looking at the market like this, where you take all these factors and blend them together and only try to trade in those instances. And that means there's going to be days in the month, not one day, days in the month where you won't even be trading. But you're not going to feel any apprehension about staying on the sidelines, because you know, based on your experience level, you only want to be trading when everything's lined up. And even though there might be a big move that happens and you weren't there, that's not the last trading day. That's not the last opportunity for you. But as a new trader, you think that way. And that clouds your mind when it comes to things like bias. Because when I say bias, you assume I know every single trading day, every single trading session, high and low. I know the bias for every single session in advance. I don't, because these markets have an element of manipulation that you can't expect to have foreknowledge of. You don't know when the next bomb's going to drop. You don't know when some terrorist attack is going to happen. You don't know when some major leader is going to have a dismissal where he's taken out of position. All these things are unknowns. So no one has the position of authority where everything is understood beforehand. And I'm not claiming that. But I can tell you with great confidence that if I can sit in front of the chart, given the things I'm talking about here, if that environment is in fact what's in play, that's when you saw me going out there and saying every 1 minute fluctuation, and it would be perfect, like perfect. Now, for some of you, when we're starting on day one with this workshop, these may be deflating. It may be, well, I was really hoping you were going to teach me how to trade every day. I will. But I want you to also know that if you don't have the experience to know what it is you're doing, and you don't have the discipline and the personal responsibility, and those factors are, you can't find them in today's social media. Like nobody wants to be accountable. They delete their live streams. I never delete my live stream. Never. Nothing that I put out there is getting deleted. Tweets don't get deleted. Videos don't get deleted. Nothing. Okay? Because you're going to make a mistake. You're going to anticipate or expect something, and you may have all these things that I've covered here. You've gone through the process and you've arrived at what you want to do. And then the time comes at the news driver event, high impact or medium impact news driver comes, you anticipate the specific price run like you want to, and then you engage it, you trade it. And it pans out a little bit, and you move your stop, and then you get stopped out. And you're going to feel like, oh no, this is horrible. I got stopped out. And you won't go back in. I'm going to teach you on Tuesday how to know when to get back into a trade when you get stopped out. How to trust the bias. And then on Wednesday, I'm going to talk about how you can trust to let your trades run. There's a lot of individuals that I see trading. They've gone through all the hard work of being willing to sit in front of you on a live stream. That takes a lot of courage, folks. It takes a lot of conviction, and it takes a great deal of moxie, balls, if you will. Okay? It takes someone that just simply has the ability to discount everybody else's opinion. But I promise you, every single one of them, when their stream is done, they're feeling everything then. They're feeling the peacocking if they did it right, and they're also feeling like, man, I don't even want to look at the comments because I know I'm getting drilled. They're dealing with it, but they have the ability to just push it away while they're live streaming. That demands respect. That's why I'll give you an example. Matt Miller. I watched the kid for about 2 years, and I shouldn't say kid. I mean, I guess to my age, he's a kid, but I simply adore him because he's not out there trying to be braggadocious. He's a very simple guy. He's not trying to be over the top, and he's doing something right now. And I've preached this, okay? Find something that's small, a low-hanging fruit objective. Once you get it, stop. And I don't know. I haven't been on social media the last couple of months because we went through some things with our family, with my mother-in-law. She's going to be with the Lord now. But obviously now I'm back in the saddle here. So, but I saw a thumbnail, and he said in the thumbnail he's taken $160,000 out of, I think it's Apex. Forgive me if I'm saying that wrong, but I think it's Apex. It's a company like Top Step or whatever. But the fact that he was able to take $160,000 out, I haven't seen anybody else do that this year. Now, there may have been someone that's made more money, but from my understanding, and I haven't watched everything he's been doing, but that sounds pretty respectable, don't you think? Did you make $160,000 this year so far? I'm not talking about fishing, Pat. I'm not talking about catching fish, okay? I'm talking about trading. And he didn't do over the top stuff. Real simple. He told you what he's going to look for. And then on top of it, he live streams it. That guy should have more followers. He should have more viewers. In my opinion, he's the #1 day trader on YouTube right now. Yes, I said it. Because he's doing it in front of you. He's proving his payouts. And it's working for him. And I'm going to suggest to him in this presentation, because I already communicated to him. I said, you're the reason why I'm going to do this lecture series the next 3 days. Because I want to encourage him, because he's feeling what everybody feels. When you have something that works, the numbers start speaking to you, and then you want to do what? I want to start cranking it up. No. See, you're trying to appease everybody else. Don't. Because that $160,000, you're going to be, you have to pay taxes on that money. Your audience isn't. You worked for it. You took the risk, all those things. So when you have windfall victories like this, and it's consistent, you have found your unicorn. I'm telling you, with 32 years experience, you have what works for you. If you tinker with it, Matt, I'm telling you, if you tinker with it, or you try to push beyond the bounds that you've discovered works for you, it's going to unravel. I've done this myself. I've seen students do this. I've had a lot of people that I've engaged in the last 32 years. I've seen them do explosive profitability, and they had something that worked amazingly simple, and they tried to do something more with it. You tried to turn a hammer into a screwdriver, and guess what? You mess it all up. You have exactly what you need. Now, it doesn't mean that you can't have another model and another account trading. That's something, yeah, I would encourage that. But what you're doing right now, dude, you're smashing it. Like, you're killing it right now. Everybody that's ever trolled you, they aren't doing what you're doing. They're not doing what you're doing, and you're not out there beating your chest. As far as I'm concerned, you're the #1 day trader on YouTube. Matt Miller, Trades by Matt. You should all be watching. You should all be watching this guy, because he's not out there. He's just casual. He's talking. And then when he feels like he wants to take a trade, right or wrong, he does it. That's what it's supposed to be like. Not, I'm trying to be king of the hill. I'm not trying to tear somebody else's company down. I'm not trying to prevent somebody to do this and do that. This guy's been trolled by a lot of people. What are they saying about him right now? What can they say about him? He's got his head in the charts. He's on the grind, and he's focusing on what he's trying to do. But he's admitted that he's feeling that tug of war. He wants to do more. You don't need to do more. Trust me, if you continuously do what you're doing, you're going to have a year that's a banner year. That means your results are going to be so over the top by doing the least. Man, that is absolutely what everybody wants to do, but can't do it. And you're doing it. So kudos to you, man. But that's exactly what I was teaching in 2022 and 2023. Find a model. It's simple. You don't need to be trading the full range. You don't even need to know bias to do that. You don't need to know bias. You just need to know how you're going to engage. And what's the smallest threshold of profitability that you confidently can see happening every single time you sit in front of the charts. And also give yourself permission that if the conditions are not there for you to take a trade, turn the charts off and get out of your house, get out of your office, put your phone away. I promise you, your consistency will go through the roof. Your drawdown will be minimized. You still will lose trades, obviously. I mean, everybody loses trades. But you won't be ground down to powder because you're trying to do more than what's required. There's essentially 20 trading days in a calendar month. Generally, there's about 2 of them that I don't like to trade on, no matter what. That's non-farm payroll and the day before non-farm payroll. FOMC, I'm not afraid of FOMC. I'll trade on FOMC. The Mondays that I do like to trade are this week. Why? Because if you look at the economic calendar down here on Friday, what does that say? Non-farm payroll. So I know that even though there's no employment data, no economic data, no news drivers with this, anything to speak of in terms of high impact or medium impact from Forex Factory's calendar. There are things that are occurring today, but generally this is kind of like a light day. But we're also in earnings season. So all these things are going to create a wild week of trading. So I want to ring this in right now. When do I avoid daily bias? When do I avoid not forcing a bias on this event right here? We have FOMC this week. We have rate announcement. We have non-farm payroll. Look at this calendar. This is a minefield. So I don't expect myself to go in on a week like this and say, okay, I need to know what the daily bias is on Monday. I need to know what the daily bias is on Tuesday. I need to know what the daily bias is on Wednesday. I need to know what the daily bias is on Thursday or Friday. I don't. I give myself permission to not have to worry about that. So what does that mean? What do I do? Well, you have to come to the conclusion that you're either going to not trade or you're going to trade. If you're going to trade, how are you going to trade? You're going to trade without a bias. That means you're going to trade intraday volatility. I have to be very careful what I'm about to say because some of you take my audible clips and you either use them in the right context, and the people that don't like me take them out of context and they make them something that I didn't say. With experience, and when you can determine when everything is in your favor for the market to be slated, bullish or bearish, and have a sustained price run higher or lower, those are the best conditions to trade in. But they're not the only conditions to trade in. When I'm trading with a market environment that is without a daily bias, I am never trading with my highest leverage. I'm not trading with 4.5% per trade in terms of risk. I never do that. I will never open myself up to that. So what is my risk per trade when I'm in a market environment where I don't have a way of discerning with confidence the assurity that I've already described how I have the assurity and confidence to do it on certain days? When all those factors are equal, then I will risk the maximum. If I miss the initial move, whether it be stopped out and I have to re-enter, or I just get to my charts late because, hey, I have a family. Sometimes, nature calls and I have to relieve myself and I just can't be in front of the charts. I'm a real person. I'm not AI. I'm a real person. I may be tied up, with something that my family requires me to do. And then I get to the chart and I miss the real ideal entry point. Then I'm going to risk about 2.5% maximum. But if all the things that I just described, if I miss that and I had to just use a fair value gap to get involved in a move that's already maybe 40% on its way, and I have 60% of the unrealized range still left to be delivered to the price, then I'll trade with 1.5% risk max. Now, I just covered a very vast array of questions that I get a lot. There's nothing I can do audibly or write into a book that's going to make that any more plainer or straight to the point. It's so plain and straight to the point that it's boring, and it's boring the socks off you. But that's the stuff that makes you or breaks you. See, you're going in with, I need to know the days that ICT wants to trade and the days that he wants to know when he wants to be a buyer or seller and where he knows the high and the low of the day. There's a lot of things that are required for that. And that's not an everyday instance. An everyday instance is unrealistic. And you can't obtain that. No one's going to be able to obtain that. Why? How can I say that with, a surety? Because manipulation is always a factor. You don't know how many times they're going to pass through an old high before they drop it. You don't know that. You don't have the experience to see that yet. You don't have the experience to determine how one single pass above a short-term high, that's enough. That creates the high of the day. Hold it and ride it through the rest of the day. But we're going to cover those things today, tomorrow, and Wednesday. So it kind of gives you a foundation and a framework. So anyway, that's enough about all that. And that's the big rocks, if you will. These are the big heavy hitters that are used for me to determine a bias. Now, already some of you probably have 1,000 new questions, and I love that. I love it because that means you're engaged. That means you're here to learn. So I'm going to transition over into price action. And we're going to look at some charts here. And what I like to do is start with the daily, weekly, monthly view of the dollar index. Now, because of all the things that's going on around the world, specifically with the Middle East, I expect the dollar to appreciate in value graphically on the chart. But that doesn't always equate to more value in your spendable dollar. Okay. The dollar is going to go higher if we have an escalation in what's going on in the Middle East between Iran, Russia, Israel. All that's blowing up. And that's going to impact your trading, whether you like to believe it or not. You might like to think, hey, in the United States, it's happening over there, so we ain't got to worry about it. No, all that stuff's going to impact the marketplace. So it's important to know these things, okay? And we've gone through Passover. We're on the other end of that. So I expect things to ramp up over there. So what does that mean? That means that I expect a possibility that the dollar goes higher. That doesn't always equate to immediate sell-off in index futures. They can move in tandem initially. There could be ugliness where it's up and down real quick, and then it starts going higher because of flight to safety or flight to quality or risk off. Risk off is dollars higher. That means all other markets are likely to decrease. But when a geopolitical wartime event happens, it's not always mark to market. It's not everything's moving perfectly in sync, because those initial moments, the market makers use that opportunity to clear the board, meaning they'll go north, south to the farthest extremes and wipe everybody out. That is why I am not trading Forex. We are going to see a major banking collapse. It's happening. You don't want to believe it, but it's coming. Okay, another bank just failed this weekend, and a major bank in the next 2 weeks is likely to fold too. A big one, something like everybody knows these banks. Okay, but these smaller banks, they've been failing, and that's why I won't touch Forex, because something really bad's about to happen, like when the euro and Swissy was depegged. And that was craziness. It's crazy town. Like, I don't care who you are, how much money you got, you're done. Your ticket's punched. You're out of there. Brokerage firms, investment firms, large traders were buried when that happened, and there's no way to protect yourself from it. It's so instant. It's like bang, it's over. You owe more money than you have. So it's for that reason, and because I don't know how to time that, because it's outside of my control. It's outside of my. I don't have the pay grade to have the intel to know when that's going to happen, but I know it's coming. So I just segue back to where I started in commodities and futures, and I'm fine with that. But the things I'm discussing are germane to every asset class. So whether you're, let me rephrase that, not crypto, because I am not a person that understands crypto. I don't have faith in crypto. I do not buy crypto. I don't sell crypto. I have no affiliation with crypto. I have nothing to do with crypto. Okay. And I sell the idea that it's going to zero. And I can be sitting here telling you that, and it can go to 1 million. I didn't lose money, and I don't care what anybody thinks about it, because I don't want to address crypto. I think it's the beast system. I'm not going to trade it. I'm not going to use it. I'm not going to spend it. And that's I'm not going to talk about it. So there you go. I can't get any plainer to the point, and that's why I don't touch it. So all the things I've talked about here up to this point and throughout the entirety of this workshop this week is germane to futures, commodities, bonds, currencies, and index futures. So everything is the same. It doesn't matter. It's all going to be viewed the same way. If I'm looking at any one of those individual asset classes, I'm internalizing the things I've covered so far. So, when I go into the charts, I go right to the dollar index first because I want to get a feel for risk on, risk off. If the dollar's likely to go higher, how do I know that? Well, we start with a monthly chart. Now, you don't have to have your charts laid out like this. Okay, if you have a laptop and you have a membership to whatever platform you're using, I use TradingView simply because my community asked me to use it, and I have no affiliation. Even though they asked me, I would receive something from them. I turned it down, and I have saved and screenshot it in case I'm ever asked. I don't get any compensation for talking about the tools or resources that I employ or use in teaching. I don't have any reason to tell you something's good or bad except for my own experience with it. That's the opinion that matters. It's not influenced. I'm not biased because I'm getting my pockets lined. Okay, I'm not producing anything that's a kickback to myself. But TradingView, you can set this up where you're just looking at one chart at a time. But I will say this: whether you're using TradingView or any other platform, if you can have 2 or 3 time frames visible at the same time, or if you have the luxury of having multiple monitors, you don't need it, but if you have the luxury of having that real estate, you can have a whole lot more insight by having more time frames in front of you. But if you don't know what you're looking for, was what I opened this lecture up with today, using that higher time macro perspective and working your way through that, then finally going into the charts. Having more charts and more monitors isn't going to help you. It'll be just one more catalyst for you to get in and lose money. So you still have to know what you're doing. So what do we do, and why are we looking at these time frames? What is it we're doing with them? Up here in the upper left-hand corner, that's a monthly chart, and I'm going to maximize it just for a moment. So this is the dollar index. I don't care what you trade. Okay, I don't care what you trade. If you're not referring to the dollar, you're not doing effective analysis. Okay, it doesn't hurt my feelings when people say that that's not true. I can do this with that. Look, there's a lot of people out there flipping quarters and making money. Okay, I don't attribute that as skill. You might want to call that skill. I don't. So when I look at the dollar index, what I'm looking for in a monthly chart is, where are we at right now? Well, that's pretty obvious. It's right here. Where did we come from? Where did we just leave energetically? And how was it left? It's real crucial. And the things I'm talking about here, that's the same thing you're doing on a daily chart. It's the same thing you're doing on a 4-hour chart. It's the same thing you'll do on an hourly chart. The same thing on a 15, and same thing on a 5-minute, and same thing on a 1-minute, and the same thing on a 15-second chart. It's not being reinvented. You're not trying to learn something, apply something entirely new just because you're looking at a different time frame. But the price delivery continuum is how price is offered to us from a higher time frame perspective, like this monthly chart, down to those smaller time frames. Where are you at on that 15-second chart in respect to what we are doing on the monthly? How many times have you looked at the chart with that perspective? How many times have you lost money and then peaked at a monthly or weekly or daily chart and said, man, why did I go long when this thing was clearly looking to go lower? Because you'll have the benefit of 2020 hindsight then. But I'm teaching you what it is I do every time frame, but I'm placing a great deal of emphasis for determining bias or feeling comfortable with trading a session with one direction better than the other. But I may have conflicting analysis on the higher time frames. We may be in a position where, okay, it's done something, and I'm going to cover what you're looking for in a second, but I'm kind of like give you moments where I may look at these charts on the monthly, the weekly, and a daily, and they have already done something, and now they're just sitting there where it can go either way. Then that moment, I'm basically going to go in and trade intraday volatility. Then I'll look for these 10 to 15 handle runs in the NASDAQ and be content with that. Not try to reach for 50 handles, not reach for a 100 handle day. Because the likelihood of that delivering is low. Not that it can't happen, but my ability to be in there on that one individual price run on that given moment and that session after the market has done something or entered an area on a higher time frame, monthly, weekly, or daily, where it could sit there for a day or two and nothing really changes on the higher time frame, but it just sits there. That's frustrating, especially if you're trying to squeeze a 200 handle run out of something that isn't going to move more than 40 or 50 handles for the daily range. You're trying to force your will. You want something that isn't going to be offered to you. And as a new trader, I fell victim to that because I thought that things I saw in books were going to just spring into action every single day. And it doesn't work like that. This workshop is going to teach you what does happen every single day and how that smallest little component can be used as a small component with another one just like it that makes a larger component or another larger opportunity, and how they nest. And that's the price delivery continuum, how we can look at all these time frames and pick buys and sell. You want to learn how to be a buyer and seller in the same day? You're going to learn that this week. You don't need to buy anybody's courses. Okay. I'm going to show it to you. It's going to be on live price charts. Okay. There's no better way of learning it. Okay. There's no better way than seeing it happen. Now, I didn't measure the delay or latency on this stream, but I always have it set to the lowest one. So whatever that is, that's what we're at. But here, if we're looking at the monthly on the Doppler, we have this up here. Now, we had a nice little run there, but now we have done what? We moved back into this inefficiency right there. That's I'm going to try to avoid putting a lot of markings on the chart. So just take your time and watch the video and play back, and you'll see what I'm referring to. But on your charts, you should definitely putting this lipstick on it. This inefficiency, we entered into that right in here and outside of it. So this candle's low. That candle right there, that candle's low. The price is 105.36. Okay, so that low for that individual month, October 2023, we have traded to it and through it. This high right above that is going to have what? Buy side liquidity. To the left of it, we have this inefficiency right here. Below us, where did we come from? Well, we came from this low here. What did that do? Consequent encroachment. This wick. See that? 50% of the wick. Wicks are gaps. Okay, that's how you should look at it. The algorithm, I know you don't believe there's an algorithm. The algorithm sees these wicks and treats it as a gap. Okay? So whenever you see a wick like this and it created a turning point, a lot of folks will look at, if they're bearish, they're going to see that low as support. And if they're bearish, they want to see that support be what? Broken. I don't look at that like that. I look at half of that wick and then the upper quadrant. Those are the most sensitive price points when you're bullish. If you did not write that down, you missed a golden opportunity of seeing something that repeats every single day. Intraday charts have this happening all the time. I want to learn how to trade candlestick patterns. Okay, well, this is one of the strongest ones, and that's not in your books. Find it. $5 million if you go through and find all my stuff rebranded. You ain't gonna find it. Now, these lows here, that was taken out. So that was a purge of sell side liquidity. Any drop down, we have this big long wick. I'm not thinking we're going to take that low out. Why? Why would I expect that not to be taken out? Because when it went down, it took out the sell side, but further to the left, what did it do? It rebalanced this inefficiency. This high of that candle and this candle's low. That little gap right there. That's a buy side imbalance, sell side inefficiency. Fair value back by classification, but it's an up close candle. So that means it's a buy side imbalance, sell side inefficiency, or BISI, B-I-S-I. It rebalanced there. Did it displace after doing so? Yes. Did it take out a short-term high? Yes. So any retracement down, if that wicks like that, your eye should be right there on the midpoint of it, which is consequent encroachment, or the upper quadrant of that wick, which would be essentially right around here. And look where the bodies of the candles are, right there on the upper quadrant. See that? That's algorithmic. That's not random buying and selling pressure. Because if you're saying that price moves simply on buying and selling pressure, what you're essentially saying is the 90% club that loses, they're directing the price action, and they're not. It's the people that they're losing to, because it's a net sum zero game. 90% of people lose money on trading, but because it's a net sum zero game, there's someone winning on the other side of that. So there's a group that's 90% winners. I'm telling you how they think and how they operate and how they engage in price. But you don't look at it like that, because it's unobtainable to you unless you know how to look at price. The game is played by taking from. That's it. That's how this works. It's presented to us as these are investment ideas. Build your future, build your nest egg, blah, blah, blah. Just like casinos, they show you all the glitz to make you get out there. And once you're out there and you lose your money, you're like, wow, this isn't what I thought it was going to be like. I didn't really have that much fun, matter of fact. And it was very expensive. So when we're looking at price, it's the same way. It's casino time. But you're not gambling. You're waiting to see the gamblers sit at the slot machine. See that? I got to use a choke up and can't figure out what the hell they're called. The slot machines, there's a pattern that these people, they do walk around like sharks. And they want to see, okay, it's this time on my clock here, this person sitting at that slot machine, and they've been going for a long time, and no big jackpots have been paid out. And they do what? They get up and they walk away. And then immediately, boom, they jump and sit down and they play that machine. Why? Because those payouts are based on ratio. They'll pay out based on a number of money going into it. That's how it works. That's their system. It's play it enough times, eventually they'll make more money than they have to pay out. But you're just trying to make a little bit of money. The people that are cruising in the aisles waiting for the dumb money to get up away from their machine, that's what you're doing as a trader. Street money's in here trying to expect this low to be taken out as support to be eventually broken, or even maybe retested, because that's what the book said. Look, we went down here and bounced away. No, in my mind, I'm going to look at these wicks like that. So if we open up a session in analysis and the market was trading down here, then I would be expecting reversal patterns to form on the daily, the weekly, the 4-hour chart. And then once I get some kind of confirmation there, then I can trust going into a hourly 15-minute, 5-minute chart and buy side and balance, sell side efficiency, fair value gaps, or buy down close candles after displacement. And then I have an order block. You missed it, didn't you? You didn't write that down. These are the parts you're supposed to be writing down. Those factors that are agreeing, it gives you bias. It helps you frame a narrative. Narrative, essentially, by definition, is understanding how the market will price an asset where it can do the maximum carnage for the express purposes of unseating potentially profitable speculators and then assuming their position and then quickly running in a direction that allows them to profit but affords nobody really a state of mind to they can go right back in and feel like they're doing a thing by re-entering it. That's what narrative is for me. I'm looking for maximum carnage and harm for the less informed traders. I can see what's going to be the reason or catalyst for them to lose or enter too early or on the wrong side of the marketplace. And when price delivers that very thing, that is the thing that gives me the green light that I can now take a trade because I've seen the manipulation. I'm not trying to be a part of the manipulation where I'm a victim of it. I'm watching it unfold. It's like, there's going to be a car accident. If you ever seen a train hit a car, it's just like that. You can't stop that train. It's not a moral dilemma. You can't, by yourself, move that car that the person saw they can't get out of the way of the train. They got out of the car. They got their children out of the car. So no one's alive in that car. They're at a safe distance away from it. And you're all speculating about how far that car is going to be thrown in the air. You can't stop it. There's no moral dilemma there for me. I'm going to watch that train blow through this car. I'm going to make sure I'm safely away from it so I'm not going to get harmed by it. But when that happens, the train passes, I have an opportunity to engage. That means the traffic that's piled up behind me is going to want to go where I'm going to go, on the other side of that track, and get out of there before all the other things that usually happen in that situation. Fire trucks, you can't move, everybody's there. The same thing with price. I'm waiting for maximum carnage. The manipulation is a timed event. You see it on the economic calendar. When there is no economic calendar event, then I heavily rely on macros. Macros are those 20-minute intervals, the first 10 minutes and the last 10 minutes of the hour that you're in, and then we start a new hour. It's the first 10 minutes. Every single trading hour is a macro. Hot damn! Did he just say that? Yes, I did. You awake? Well, they're boring you? You're awake now, aren't you? Holy shit, ICT's screaming again. It's audience management, folks. I got to get you awake. Remember I told you I could trade every single 30-minute and 60-minute candle? Because there is a macro. That 20-minute interval is there on every single hour. Now, the ones that cause intermediate terms in market structure changing and turning are the ones at like 9:50 to 10:10 a.m., 10:50 to 11:10 a.m. Then you have 1:50 to 2:10 p.m. and you have 2:50 to 3:10 p.m. They are the ones that you should study them first. But when you get really good with knowing what it is you're trying to look for, I'm not done with that yet, but I'm giving you a lot of foundation here. This is what would look like filler in a book. You know, there's going to be chapters, unless you understand and appreciate what I'm showing and discussing here today, and we're going to apply in real price action, you won't be able to appreciate the level of wow factor, because it clears a lot of the questions that you have about what it is you should be doing, what you shouldn't be doing, when things should happen. What do you get when you have a news driver that is a 10 o'clock news event on a day where you have a seasonal tendency behind you and the market structure supposing that it moves in that same direction that the seasonal tendency implies, and you have a high impact news driver or a medium impact news driver at 10 o'clock? You think you're going to have a good move at that time? You're damn right you are. And if it's done maximum carnage by going higher, slightly higher, and then at 10 o'clock that news driver goes a little bit higher than all the highs that's been there, but you've been bearish, that's so beautiful, because I will take that as a turtle soup and I'll sell short. And then when it has a shift in market structure bearishly, I'm going to sell the first fair value gap that's bearish. I'm going to add on a breaker that's bearish. And I'm going to keep building every new pyramid entry I can that's an up close candle. As soon as it touches the low of that up close candle on the time frame I'm trading, I'm going to add another smaller position size and pyramid on it until I get to 60% of the range, okay, is still unrealized. That means 40% of the move has already happened. Then I stop pyramiding. I don't want to take any more pyramiding entries at 50% of the range I'm expected to see pan out on that trade. Why? Because I want to keep my last entry in my pyramided entry, where I'm building these positions where I start with like 6 contracts, and then I'll do 4 contracts, and then I'll do 3, and I'll add 2, and then I'll add 1. I want that last one to be in the upper 40% of the range that is expected to be delivered to me as my profitable trade. There's rules to this stuff. It's not random. I'm not just pulling stuff out of my rear end because it just sounds good to talk about. I'm repeating these things all the time. Go back and look at my execution videos. I can't edit it. I can't make them seem like I'm doing that. That's exactly what I'm doing. On the days that I want to do something, all things being equal, that's how I'm doing it. Now, what happens if you start trading like that? When you have a very selective process of knowing when you're trying to do something, when you're not trying to do something, you're going to have a greater command over your emotions, the psychological impact of what you're trying to do, or you're trying to avoid losing trades. By default, this will maximize the likelihood of you not suffering as many losses. It will not prevent 100% likelihood of being profitable or unprofitable. There's never ever going to be something that removes that likelihood of you losing. That's always going to be there. And the reason why that's always going to be a constant is because manipulation is always likely to occur. And that uncertainty, the things that you don't see coming, that's going to be the catalyst for you taking a losing trade. And if you think that losing trades are going to be the end of you, then you can't be a trader. You can't. Okay, so when we're looking for bias and trying to derive a bias, I start on the monthly chart and I want to see where we are. We're here. Where did we come from? We came from recently, this low here. Why did it react there? What I just explained over here, taking out the sell side. We rebalanced this inefficiency. So really, what have we said here? We've completed every necessary thing for a discount. How do I determine the discount? How is that a discount? Here's one of those instances where you can copy. These are my settings for fib. Okay, so screenshot that. All right, so here is premium. This is the high it's been during all this drop down, and this is the lowest point it's been in. So this is your range for determining premium to discount. Equilibrium is midway. It trades up to it here. Notice it did that from high to low. It came right back up to midpoint, equilibrium. If you're bearish, equilibrium is premium. It can be treated as what? Think of it as like resistance in terms of retail theory. But there's nothing over here that's resistance. See that? There's nothing here definable in terms of classic support and resistance. So it's just the measuring of overbought, oversold in the context to the range in which the price has been offered to us. That high to that low. We are still in what area of price action relative to that range? Below equilibrium. So we are still, all of this is discount. We're in a discount market. Now, is it likely that the dollar is going to go higher or lower given this information? Well, that remains determining on what it is that we just left from. We went higher from this low, which was a reaction off of the consequent encroachment of this wick. When the wick went down there, it did two things. It disrupted the sell side stops here, and it rebalanced this. So pray tell, why does it need to go back down here? It doesn't. What has it not done? It hasn't made its way on a closing basis above equilibrium. And watch. This high here, that liquidity is buy side. I wish I would have had this stuff when I first started. I would have probably been way better if I would have known this coming in. Okay, so right away, what this does is this tells me, because I've done qualitative analysis and quantitative analysis, I've based all of my premise on the fact that, what do I have here? I have a range from this high to that low. And we're inside that range. Is it more likely that we're going to go above this high or below this low right now? Well, if you were looking at in terms of the closest proximity, most people would say, well, it's probably going to go down below that low. I'm not thinking that. I'm thinking that we're staying in a discount right now for a larger, longer term price run higher. Here's the kicker. I do not need this high to be taken out. And I don't believe that this low needs to be retraded to, because we've had confirmation here. Consequent encroachment was offered and it displaced higher. We had sell side taken with that drop here, and it also rebalanced. That's every possible thing that would constitute a reason for the market to turn higher. So the work essentially has been done on the discount level, on this chart, on the monthly. Now we have to do the same thing on the weekly, the daily, and any time frame less than the daily chart that you use for your trades. And I'll leave that up for whatever it is, because we would be needing a whole month to cover what it is I want to cover. So what I'm saying in plainest, simplest terms is we already went above this gap on that sell side imbalance, buy side efficiency. We should have been looking for it to drop here if this was going to continue going lower. And it didn't. It just kept going higher. You have mean threshold of this down closed candle, which is a bullish order block. It trades to it here. Did it react higher? Yes, it did. It went above this inefficiency here. So what is left on the upside, or in a premium perspective? This high and this inefficiency in here. So this confluence of this high having buy stops and inside this inefficiency, and if we split that in half and get the consequent encroachment or midpoint of that gap, you have a high degree of probability. I trust, I believe, I'm not saying that you should, this 50% is equilibrium on that range from the highest high and the low that we were just talking about. And right in here, this little shaded area has buy side and up to the midpoint of this sell side imbalance, buy side efficiency. I do not need, you don't need it to trade above the midpoint of that gap to find opportunity. So where we are right now, we're in a discount. Where have we come from? A deeper discount, a rebalancing, sell side been taken. We had confirmation given to us here with the consequent correction of that wick. We displaced higher, and we broke through what would normally be expected to see what? Hit in here and go lower. It hasn't done that. So the untapped opportunity is buy side hasn't been taken in that range, and the inefficiency over here, and we haven't gone above equilibrium on a closing basis. So there's three factors right there just on the monthly chart that tells me higher dollar eventually. Does that mean go out there right now at 941 and be long dollar, short everything else? No, it doesn't mean that. But that's the stepping stone, okay? So you build your foundation on bias and premise with that context. So I'm going to take this off here, and we're going to drop down into a daily chart. All right, so now having this stuff on the charts like this, that's that fib. That's a measurement also. Look how it's like consolidating around that. You're probably asking yourself, what are you talking about, ICT? Let me go back out. That low to that high, that's this level here. This level here is equilibrium. Of the range of that high to that low. I'm going to just keep your eye on this level right here, okay? Watch. I'm going to take this off. See how it disappears? That's the low of that shaded box. That's halfway or equilibrium, the midway point of the range from that high to that low. This one here, the upper line, that is the level that creates the midpoint of this inefficiency from here to here. And I'll show you that by deleting it. See how it goes away? So that gives you the calibrations to when we drop in the lower time frames. That's what those levels are. In your charts, you may want to put a little line segment on it and annotate it with, monthly sell side imbalance, buy side inefficiency, consequent encroachment. And that would look like M-SIBI CE. So that gives you all the details as to what you're looking at on a lower time frame. Otherwise, you won't know what that level is for. You don't know what that line is. Okay. So with that said, let's go back down into a weekly. I think I was in a daily chart before I should have been. I think I was, yeah. So here we have the weekly chart and the same thing here now. We look at what it is that is likely to occur. Inside that little blue box, that's the draw on liquidity for ICT, Michael. I believe that that's where the dollar index can draw to. But now when we entered into the weekly chart, we have new imbalances, short-term buy side, relative equal highs. It does not change this. It confirms, and in my opinion, it qualifies it more as a likely draw on liquidity. And if this is true, and time will remain the deciding factor here, if it draws up to here, you want to go through your charts and backtest every turning point that unfolds from this point forward until it gets up to here, okay? We have this inefficiency right there. You can draw that out. I'm not going to, but I'm going to show you how it went down into that buy side imbalance, sell side inefficiency, and it touched exactly on its consequent encroachment. The low is on that candle, 105.414. It went just below it enough to hit it, but not go drastically below it. Did it react there? Yes. Then we opened, traded down. We can have initial, because it's Monday, we could see it drop down and close in this inefficiency. Personally, I'd like to see some of this left open. Why? Why does ICT like to talk about certain candles that are a fair value gap? Why does he like to see some of it not close in? The fact that we're where we are in price, we've already came down and traded into an order block. That's this one here, this down closed candle. With a fair value gap, it dropped down once, twice into the fair value gap that's formed and touched the order block, the last down closed candle, within the context I've outlined it. That's why this is a down closed candle that we can call order block. All the things that I have been jawboning on from the monthly chart, trading down into, well, not trading down, but adjusting our focus to now a weekly chart, the down closed candle in this instance here, that constitutes and makes that a valid order block. That's not a demand zone. That's not a engulfing candle that does this or that. It is an order block. The opening price of this candle right there, that is the change in the state of delivery of price, meaning that is the very trigger. That's the catalyst. It's not this range. That's not a zone. I'm not looking at a zone. I could care less about supply and demand. It's a fallacy. To me, all they've done is taken support resistance levels and made it more ambiguous by calling it a zone. How the hell are you going to find the right price inside that? How are you going to do that? How are you going to do it consistently and be able to say, this is what I'm going to use all the time? They don't teach that. You have to figure out something still. Okay, I've done all the figuring. I know what price I'm looking for. So if we're seeing how price has already reacted here, and it showed displacement, it rallied up into this high. There's a lot of order flow that's going, and remember, this is a weekly chart. Upper left-hand corner, you see that's a weekly chart of the dollar index. We're still just working out the risk on or risk off. It doesn't take you this long. It's taking me this long, so I want you to understand. I want you to know why I do certain things, when I do it, why I am not interested in certain other things, and when I'm going to consider other things that we've yet to talk about. Because I'm trying to teach you how to do it without having me help you anymore. You want to have that mentality that's independent. That's what I'm trying to foster in you. I don't want to spend my days doing long-winded talkings. I do it so that way it helps answer a lot of questions that you don't see coming to me. And I'm doing a great deal of, or putting forth a great deal of effort to make sure that I'm communicating it to you in a manner that I can only do it this way. I don't know how to do it any better than that. And I've already said I'm not the best mentor. But to understand what it is I'm doing, this is exactly what I do. So when I do it, you can have a framework to say, okay, this is what he does. But it doesn't take this long. when you do it. Like I said, I go through the dollar index. I do the indices, the Dow, the NASDAQ, the S&P. I use a handful of major currencies like the pound, the euro, to solidify risk on, risk off. That doesn't mean they all have to move in concert with one another. We will talk about Forex to kind of like build in the comfort level that it still works there too. But there's also details that you want to be able to glean from using the concepts. Even if you don't trade other asset classes, their input technically will support or negate an idea, or it'll have a factor that weighs on me in terms of how much I'm willing to risk per trade. If everything's in agreement, man, that's like a lead pipe cinch trade. Like that's a given. It's going to happen. But if I have half of the things I look at that is telling me, yeah, these things should be going lower when the dollar goes higher, I'm not going to risk my maximum amount of leverage because of that factor. You see how all these things, there's rules. There's rules to these things. And it helps you graduate to a level of comfort because you're following rule-based ideas and processes and protocols. So that way your attention is focused on adhering to that process or protocol versus, am I going to make money? Is this going to stop me out? What's going on? Who's doing what with another? Let me pull up this live stream and see if they're trading a Dow today because I'm looking at the NASDAQ. I want to make sure I'm picking. How do you know that person's even going to have the right one too? You're guessing whether or not you have the right one. Just trade one. If you get stopped out, who cares? If you have a system that works, you're going to get a winning trade and that loss will be mitigated. But it doesn't need to be mitigated immediately. But that's what you want because you have a TikTok mentality. Give it to me right now and it's 3 days late already. So we've had this inefficiency traded to and displacement to the upside. Now we have this inefficiency here. And we traded down to it here. There. And now we want to see price ideally leave this open. But because all of the news events that's due out this week, what can we allow for in our analysis? Are we going to demand that it stays open and be hardlined about it and dogmatic? It has to stay open because ICT said so. No. I would prefer that it stay open and not completely come all the way back down and touch this candle's high. I'd prefer that it doesn't do that. Because if it does that and remains open here, that this swing low on the weekly chart can be trusted, and it's probably going to move, if not this entire week, going into next week, up into here to draw to that buy side. Because these stops here, they made money, but they're squeezing on them. And because there's no inefficiency in here now, in this range, what is there? It's the focus on the stops. And those stops also reside in a monthly inefficiency over here that doesn't look all that inefficient until we get over here. So I'm not trying to make a hardline case that we're going to trade up into here. I don't need that. What's the low-hanging fruit? Where's the level at which I need to focus on, and it's all I need to worry about for this given week or this given day or session? That the likelihood that the market could gravitate to here. And for all the reasons and factors I've already mentioned. But let's say you're a scalper and you don't have the confidence or the ability to stay with the trade because you don't have the experience yet. You'll have to learn how to do that over time by taking demo account trades and tape reading and staying in it when you feel like you want to get out. Just stay with it and see what happens. Don't trail your stop loss too tight. Don't strangle it. And just let it happen. If it can't encourage you to hold to this type of move up here, where's the next short-term buy side? That's this high here. So you could take that and that would be your short-term scalping draw on liquidity for today, tomorrow, and Wednesday. Now, that's not a lot in terms of range, but it's enough for you to take a euro and cable trade in. If it runs here for the dollar index, that's going to send the pound and the fiber market, euro dollar and pound dollar, lower. Because dollar up causes what? Risk off. Risk off will be assets decline. There's no interest in buying them. So they'll go to a discount to encourage purchase. So this is the draw on liquidity on the very, very short term. Intermediate term, it's this one here. Longer term, this inefficiency here, which is both weekly and monthly. And then maybe, but I'm not going to tell you because it's so many uncertainties that's in the economic climate right now. I'm not going to sell the idea that I'm going to say it's going to go up here. It could. If we have a nuclear bomb dropped off any country in the Middle East or even in the mainland U.S., nothing's off the table. You're going to see dollar go 135, 150 because that's a shock that no one's ready and prepared for. But I'm telling you, we're going to see that. We'll see it before. We'll see it. Let's leave it at that. I got to be careful what I say here. I'm on YouTube. The short-term draw on liquidity is here. Intermediate-term draw is here. Now, with that, we can drop down to the daily chart. Man, we finally made our way down to it. Now we have this inefficiency. Look how many times we've been in here. Once. See, we're there. Lower, 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 all the way down into here. Notice that we completely went outside the range of this buy side imbalance, sell side inefficiency. But it was only on the basis of what? The wick. What did I teach you? The wicks do the damage. The bodies tell you the story or the narrative. The bodies are stopping inside of that inefficiency. See that? I'm going to show you here in a different color so it pops. Okay, so we dug down. The bodies are telling you the narrative. It's the storyline. Yeah, we went down to that level, but that's the weekly chart's fair value gap's consequent encroachment. It's the midpoint of the weekly. So the price delivery continuum, moving from the higher time frame down the lower time frame, we're teaching you how to effectively look at it algorithmically from the top down, not using retail logic, not using support and resistance, using inefficiency and or order block. It's one or the other. That's the turning points, okay? The turning points are going to be liquidity based or inefficiency based. Entries are always formed on the basis of inefficiencies being retraded to or order blocks being repriced to. If you don't have that written down, you missed it. So the bodies are telling us what? We have done what we need to do. Yeah, we went lower, but don't be scared now. Don't be afraid. Even here on this candle here, on this daily candlestick, we went just a little bit outside of the range that frames that fair value gap. So when you look at my live examples, or where I've also talked about it live and did like tape reading with you, and I'll say, okay, this is normal, this is completely permissible, it's outside of the range of the fair value gap, but it's a mohawk. It's like a little tiny coloring outside the lines. And I use the analogy, if you have a child and you give them a coloring book page to color, they colored outside the lines, but you're never going to tell your child, look at this, you idiot. Look at this, you messed up. Look how you colored outside the line. You're not doing that. They colored it, and you put it where? You put it at your desk at work, or you hang it on your refrigerator. You have an affinity for that. Well, when I see my algorithm constantly doing what I want it to do, I had that same thing. I expect it in certain instances to color outside the line. How do I know when it's likely to do that? Because I want a higher time frame, like we just had on that weekly chart. That's this inefficiency here. That's these levels here. And it only went down to halfway point of it. Rewind the video. I have it on DVR settings, so that way if I say something, you can quickly rewind it and then click the live button. I'm not deleting anything. Every video I put up is never getting deleted. Okay, the live streams don't get deleted. So if you can't watch the whole thing, or you can't stay with the whole session, it'll be here when you come back to watch it. But this dropping down in the lower time frames, that is absolutely permissible because of the higher time frame inefficiency. Now, how far can it trade down? It could have ultimately traded all the way down to here on a wick. Why? Because it's a weekly chart inefficiency. That's the low of the inefficiency on the weekly chart, and the high was that level, and the midpoint of it's here. That's why it went down there. But now, because we have had multiple instances of this, and we have one more pass here, and it didn't go below that low on this one here, where I would have demanded it had done that. If we can keep this candlestick from closing below here, everything I'm talking about, I'm still sticking with a bullish dollar. That means risk off. That means that, yeah, indices might rally on the short term, but I'm more interested in eventually seeing it roll over and give me an instance where I can get short because of the underlying risk off scenario that may be unfolding in the future. So that right there is the 85 to 90% framework of how I determine daily bias. Now, how do we segue from the daily bias to a session bias? Well, we've been trading at 9:50. I did a good job. I want to make sure I was in the indices by 10 o'clock because the opening range is done. So we're going to go into NASDAQ. NASDAQ. And we are on a daily chart. So we have no news really to speak of that's all that impactful today. We have huge news events tomorrow, Wednesday, Thursday, and Friday. Okay. So if you're going to be looking for trades today, try to keep them as a scalp because the large range deliveries, the big runs, the big moves, okay, in other words, don't try to demand a 100 handle run on NASDAQ today. It's highly unlikely. It's not probable because that's being reserved. All that movement is being reserved for these impact drivers that's going to release Tuesday, Wednesday, Thursday, and Friday. So it's like expecting to see your favorite baseball team to come through the corridor and get a signature from them the day before the game. You might be there, ready to stand there and hold your little pen or hat out for a signature, but they're not there. So the big plays aren't going to be here today. They're going to be there tomorrow, Wednesday, Thursday, and Friday. So the reason why I timed this, whether you would have put 10,000 likes on the post or not, I was going to do this anyway. But it's this week I wanted to teach bias because this is the week that's the hardest one to derive it. But the things I've said about when it's not this week are so simple that you'll be able to be fine with it. Okay. But this week, you want to try to avoid holding a daily bias over yourself because you're not going to know the daily bias. I don't know the daily bias. There's too many catalysts for the market to go into a wild, just craziness. Trust me, this week is going to be crazy town. You're going to see a lot of volatility. You're going to see price runs that are going to go against what should be obvious. So what does that mean? You need to be a scalper this week. You need to be a scalper. Pick your shots. When you get the range you're looking for, your 10, 15, maybe 20 handles, be content with that. Take majority of the trade off and then see what you can get on any kind of runner. But don't hold with great deal of conviction that you're going to get this one-sidedness. It could happen, but it's more likely that it won't because we have all these things that are happening all in the same week. We have FOMC, rate announcement. We have non-farm payroll. We have, good grief, everything else that was listed on that economic calendar. So while it will present a great deal of magnitude in terms of up and down volatility, and that's wonderful for short-term intraday trading, it's problematic for sustained one-sided runs, which is what daily bias is helping you focus on. Daily bias, the only real essential necessity that I attribute to it is for a new trader, what side of the marketplace should you focus on? If it's one-sidedness and it's bullish, then you should be looking for those macro times or the opening range once it's completed. That will give you the intel to tell you when and if your buy is likely to be trusted. Filtering out going against the daily bias. And because you don't have experience, that right there will limit your exposure to risk because you won't be trying to go against the daily bias and you won't get tripped up when the market starts to move parabolically against what your daily bias is. You don't get tripped into chasing price. And if you do it wrong, it's okay because you're going to do it wrong forever given enough times to trade in a month. You're gonna have losing trades. Trading is managing losing positions. That's what trading is. All your entire career as a trader is going to be you managing equity drawdown. Everybody has it. Everybody, experiences it. And where do you go from there? That's what trading is. And your goal is to make money by the end of the year. You can't determine how much you're going to earn, but in the beginning, you have to keep the money aspect out of it, because if that's the reason why you're trying to learn how to do it at a rushed pace, that's going to be the very catalyst why you blow up. And you're only looking at it from one side, because that's the side that you want to experience. So with that said, we have on the daily chart, the market has moved from this high down to that low. So we have a range. I'm picking this candlestick high because it's the up close candle and it's the highest high and that low. Okay. We are essentially above equilibrium. We've closed it there. So we're above equilibrium on Friday. And then we have today. We're sitting around in an indecisive day, which is classic for what the economic calendar shows us. To the left of that, we have this right here. What kind of inefficiency is that? It's a sell side imbalance, buy side inefficiency. It's a down close inefficiency or fair value gap, which is a SIBI, SIBI. About 15 comments are going to come to me. You could do this if you do this, that, hold control. I know. So this sell side imbalance, buy side inefficiency, that is the premium draw. So because of the volatility, because we mentioned how the dollar could trade lower a little bit, because of the volatility that's likely to be seen and witnessed because of all the economic calendar events that's on the menu for this week. If the dollar drops down a little bit, it could send us into this fair value gap here on the NASDAQ. So you want to have this level, and you also want to have the consequent encroachment and quadrant levels on that inefficiency. And I'll show you how to do that now. On your fib, you should have a setting down here for 0.75 and 0.25. What that will do is give you the upper and lower quadrant. That level right there is the midpoint, which would represent a consequent encroachment of a gap or inefficiency or wick, or it would be equilibrium in the dealing range. Okay, so, and this is the high and low of the range that you're measuring. But these levels here, that should be toggled. And what that'll do is it'll give you the gradient levels inside this inefficiency because we're on a daily chart. So in plain English, I suspect that we will see us go into this range here. I am expecting it to trade to the low, the lower quadrant, and as much as the halfway point or consequent encroachment of this inefficiency. That is my Monday, Tuesday, Wednesday bias. That's all I'm holding for in terms of what it can do. Now, with that said, if it can go beyond this midpoint on a closing basis, but doesn't go up here yet, then I'll anticipate the market resuming when it opens at 6 o'clock later in the evening time. I might take an Asian session trade to try to reach up in and get that inefficiency closed in. Or if it consolidates and drops back down to the low of that inefficiency during Asia tonight, going into London, in the morning between 2 o'clock and 5 o'clock in the morning Eastern time, I might take a long if it did what I'm explaining, and then try to get a run up to get that closure there. Or tomorrow's New York session, I might be interested in seeing that trade there. You see how everything moves from, if it does this, then I will do that. If it does this, but not that, then I have to sit on my hands and wait. It's not, well, I have a bias, so let's go out there and just start pushing buttons. And then you wonder why you didn't get the results you're looking for. You have to take your time pick your shots, know what you're looking for, but that knowing what to look for has to be in line with the time of the day. And since we have really nothing to be a major catalyst on the economic counter to create some big explosive type moves higher or lower, we can spend more time with this type of analysis to build where the market can go to and why it would be more likely to do this than to go lower. So much like I just outlined with the dollar index, we can see the framework here. We have the market turn here. We rallied up. We had a single down close candle. It traded into this down close candle on the daily chart. That opening price is the very price that causes the change in the state of delivery. What that means is it will now change its directive to now seek premium inefficiency or buy side or a combination of both. So my order block is not a supply and demand zone. I'm looking at the opening price. If it's a down close candle or an up close candle, that is the very trigger, that's the mechanism, that's the price, that is the salient point, that's the bullet point, that's the factor that you're looking at, that's the very thing, that's the key crucial point of information, that opening price. That is going to tell me everything I need to know in terms of where the market's going to reach for, how it's going to deliver, the speed, the magnitude, is it going to continue, and where that order block is in market structure is going to tell me if it's going to be a target, if it's going to be an initial entry, if it's going to be a factor for where my stop loss should be placed above or below, respectively. All those things I'm going to be teaching you this week, but I can't compress it all into the first lesson. And it's not important that you're watching this live. So if you're able to watch it afterwards, that's fine. But you're going to need to watch these 3 live streams several times because there's going to be a lot of information in it, 3 decades of it. But that opening price, that is the change in the state of delivery, meaning that now, because what we were doing was we were going lower, seeking a discount. When we went above it, when the narrative suggested that we could potentially turn and go higher, the technical aspects to it is that down close candle and its opening price. Now, watch. I'm going to put this opening price right there, and we'll make it blue so that way it's very large, it's prominent, you can see it. We're going to go down to the lower time frames in a moment, but that price is like a trampoline. Think of it like that, okay? When price is above it and Trump trades back down into it, it'll create, if it's good, it will create feedback in price delivery where I call that a signature. If price on the lower time frames are supporting or it rallies away from it and then creates a fair value gap above it, I'll take that as a fair value gap entry and go long if it's a scalp and get 10, 15 handles, 20 handles if I can and be done. And that's trading without a bias. Light bulbs, right? So we'll come to that in a second, but the market traded down here into that candlestick right there. Same thing. We're going to do it with a smaller one. ICT's delivering information on the order blocks now. Finally! There's so much stuff to it though. But this is the simple, direct, right to the point. So that way it gives you useful information. The down close candle, where are we at in respect to the range from here to here? We're still in the discount. Here's the equilibrium price point. So this down close candle is absolutely crucial information for you taking trades. But this is a daily chart. So you have to allow for coloring outside the lines if you're using lower time frames. So it can do a whole lot of things beyond that specific level. But I'm going to show you what you're looking for that constitutes and qualifies a setup. One that you would see me outline like when I was on Twitter saying, okay, look at this 1 minute candle right now. Go back to this 1 minute candle. At that range, we're looking for that fair value gap. A lot of the goobers that were watching that went back and tried to take things out of context and said, look, he was looking for a sell. You did not hear me say sell or buy. I'm taking your attention to that very fair value gap because if we can trade above it, what will that be? An inversion fair value gap. And if it trades up to it and rejects it, then we can take that information used for a subsequent setup or PD array to get short, whether it be an up close candle for bearish order block purposes or a smaller time frame fair value gap that trades up into it that would be a trigger point to get short. It's for me to teach you live where your attention should be. And by using that information in the context of a narrative and a bias, that's your full panoramic view of how to engage markets for trading purposes. But in the beginning, you shouldn't be pushing a button, not even on a demo. You should be practicing and just studying how price delivers, because then you can see it without any monetary reward, no pain and suffering if you did it wrong. Nobody saw you expect it to behave a certain way, and you journal that. And you sweet talk yourself saying, I had fun, I enjoyed watching this today, and I learned that the market had difficulty, not you, the market had difficulty going below this specific PD array. And I was thankful that I could observe when that occurred. And I'm going to do more research to see why it did what it did there when the week closes. Where does that event fold, or I'm sorry, fold, not fold, but unfold in the grand scheme of the weekly range? So you're not giving any negative to your journal. You're identifying areas where maybe you were watching the tape live, or maybe you did do a demo trade and it didn't pan out like you thought it would there. You're not vilifying yourself. You're not being highly critical in a negative sense, but you're very reasonably highlighting areas of opportunity for you to discover more information. So it's real important that you manage yourself that way in your journal. So we have two down close candles here. You have bullish order block in the lower portion of the range, the lower half. Once we get into real close to that equilibrium price point, order blocks can become 50-50. And it really demands your understanding of why you think it should go higher anyway. Because you could see a down close candle at or just above equilibrium, but if you lose the sight of where over here can it trade to, it could be just trading to a short-term premium and then collapse aggressively. And you may be thinking, well, I'm using an ICT bullish order block and it should go to the moon, baby. And maybe you didn't use a stop loss because you think you're going to be right. And it comes back and does damage to you. That one event, that one trigger moment where you didn't do what you were supposed to do because you had everything all in Texas Hold'em style and you had your rear end handed to you. That one small little event in your entire career will be magnified. No matter how much money you make, that one little piece of scar tissue is going to be a barrier and a hindrance to you doing things that you would have otherwise done more efficiently because you hurt yourself, not listening. So anyway, this candle's high. That's the draw on liquidity for me initially. Then it's this specific price point here, 18,021, because that's the lowest quadrant that's above the lowest of this fair value gap from that candle's low and that candle's high. That's your fair value gap. So it's this. I'm looking at this range here. But the very specific price points in that range I have based on this. The lower quadrant. And this is not quarters theory, by the way. Okay. Find this in quarters theory. It's not there. What I'm doing is I'm grading a price swing. The price swing is the difference between this candle's low and this candle's high. And because the markets are algorithmically booked and delivered, they're going to go to this level, and then they're going to go to that level and that level. And how I'm using this information is I want to see a trade here. That would be a nice area to target first. Then if I have a long position on, then it would be this level here where I would take a partial. And then I would take 80% of the trade off at that halfway point and leave a runner on to see if the daily range can. I'm not saying it's going to do this today, folks. I'm saying this is my Monday, Tuesday, and Wednesday bias. I want to see E-mini NASDAQ trade up to that. That's what I went into the week with that. I'm giving it to you live as I'm doing it, and I'm telling you why and how I came to that conclusion. I didn't just pluck it out of the air. And this method or process is what I do every single week and every single day. Now, if it can close above that midpoint of this fair value gap, which is consequent encroachment, that price being 18,054.25. If it can close above that, then I would expect, whether it be Asia, whether it be London or New York session tomorrow or the PM session, I would be looking for reasons to justify how it would go up and close in the upper portion. But if I can get a long in around the equilibrium of that range or inefficiency, consequent encroachment, the midpoint, that price, then I would take a partial at the upper quadrant because it doesn't have to fill that in. You see what I'm done? I've removed the necessity of being right. I have to be right or it's not profitable. Bull. You just need to be worrying about controlling the drawdown, managing risk, and when the market affords you an opportunity to pay yourself, you pay the trader. That's how this works, folks. But you have to predetermine where you're going to try to aim for a partial. You just can't just feel like, oh, my elbow's twitching. Last time I had a muscle cramp like this and I was in a trade. It turned on me. So, I probably should take one now. Let me take a partial off now. You're trading from physical stimuli. You know what you're trading off of? Cortisol and adrenaline. And nobody's thinking clearly when that's going on. So you have to have your levels for targeting, whether it be partial or conclusion or terminus, where you're completely out of the trade entirely. They have to be determined before you enter the trade. If you can't time your entry and get in it with a target and where your partial should be, you shouldn't be entering the trade. Because what you're going to do is you're going to enter and you're going to find out how you feel as the trade goes along. And what that means is you may have had a small inclination of a market trading 10 handles, but because it moves 12 real fast and sudden, now you're in there for a whole day. And then you'll watch that profitable day. You might get 30 handles, 40 handles, 60 handles. And you're like, man, I'm going to the bank today, honey. Pack the bags. We're going to Vegas, honey. And at the end of the day, it's gone. And you lost $1,000, or you blew your funded account, or you blew your trading account. Instead of saying, I'm not just trading today. I'm trading until I can't do it anymore. And I don't have the mental faculties or the equity to do it, or the markets are kept from me. I'm going to be trading. So therefore, I have to do this as a business. I want to take